Hello value investors, thank you for joining me. Today I want to talk about Money Masters of Our Time by John Train. This is the second edition. As always, I hope you subscribe to the channel so you can get my next value installment. Also, check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you which stocks I own and why, with a balanced argument for the stocks I own. So let's get started. So I'm going to talk about 5 investors. It has many more than 5 investors here, but these are 5 investors that I believe are quite helpful to an investor starting out or maybe just looking for some refreshing. So the first one I want to talk about is John Neff. The second one, John Templeton. The third one, Fischer. The fourth one, Peter Lynch. And last, but of course not least, Warren Buffett. So John Neff is an interesting character. He basically has a very long track record, 31 years I think he comes out. And in that time, he doubles the S&P. And what I think is quite interesting about his strategy is that it's very much looking at very slow growth companies, but very insistent on having net income. Now, his idea being that capital intensive businesses would not be very good businesses. You want a business that can spit out a lot of free cash flow. It doesn't call it free cash flow, but that's the idea behind it. So its idea of that it has to have quite a significant amount of dividends making up the investor's total return. John Neff also has a book that's half biography, half his investor strategy, which I think is really helpful. And what I particularly like about John Neff's investment style is that it's very much a systematic style. So it's very much, in this modern world, would be very much appropriate to be a quantifiable strategy. I'm not particularly sure, he's a Midwest type, so I'm not particularly sure that he would be the kind of quant investor, but I do see that it's very easy for his style to be put through some kind of screener and something come out at the end. So I think that in the modern world, he's someone that's very, very applicable, because that idea of looking for a business that spits out a lot of free cash flow. Presently, he would probably be looking at asset-light businesses rather than capital-intensive businesses. I think that that could be something that would be quite interesting. Moving on. John Templeton is the next investor that I want to talk about. John Templeton is an interesting investor because later in his life he totally did away with investing and he went on a mission to preach religion. However, his style of investing is quite interesting because as a money manager he was one of the first people to really look abroad. So he's British-American investor, Sir John Templeton, and he went and was looking at investing in, let's say, Japan at a time when no one else was doing that. So his quote is a famous quote that markets are born on pessimism, they mature on optimism, and they die on euphoria. So he's very much a contrarian, and it's very much of buying at a time of maximum pessimism. I think that any time that you make an investment, you got to consider that. You got to consider if you're making an investment in a company where the bulk of the people are optimistic, it's going to be difficult for you as an investor to know something more that is not already priced in. It's difficult. And to argue that, yeah, okay, I have a longer time horizon. Everyone is a buy and hold investor as long as the share price is going up. Nobody is anything else but a buy and hold investor. It's only when crunch time comes that people are like, this might not be the smartest idea. So that is not to say that there are not some great companies, household names. I own one that could, is very expensive priced and it could continue to go ahead and it may still beat the index over time. So just because something is expensive today does not mean necessarily that it's going to be not going to be more expensive in the future. But when it comes to John Templeton, his strategy is very much buying at the time of maximum pessimism. You know, the anecdote is that he went into the stock market in 1939, you know, just before the Second World War, and that's obviously a time of maximum pessimism. He also has a book, which I've also got a video on, that talks about John Templeton. So I think that he's quite an interesting character to know, and I think that he's such a humble investor. You know, he moved out to the Bahamas, and also there's a story that he moved out to the Bahamas, and one of the advantages of living in the Bahamas was that he'd get the Wall Street Journal the next day after it was posted. Obviously nothing else about the Bahamas works, but getting the post one day late was his recipe to success. Now, joking aside, Philip Fischer. So obviously Philip Fischer is a great investor, and more about what he offered to the investment community. I don't really know anything about his track record. I know the one or two picks like Motorola, obviously, but I don't know anything about his track record, and he's very, very much quiet on that front. It's really difficult to. You've spent a lot of time trying to find his track record, but when it comes to investing, you need to not necessarily copy the right investments, but it's copy the idea, right? So you are looking for businesses that have a very strong potential ahead. Obviously, I don't have any position in Microsoft, but this would be something like that, right? So it's a position that you can buy and you can just hold it for a really long time. So looking for businesses that are very high quality, and you're looking for businesses that are like a toll bridge. That's why I always think about Microsoft, because that's like a toll bridge. You know, every enterprise has to buy some sort of package from Microsoft, either whether it's Office, taking a subscription there, Azure, or you know, like pretty much any enterprise, you have to pay a toll bridge to go through Microsoft at some point. So that's it. I don't have any position in Microsoft, but that is something that has a lot of appeal, and I could imagine that Philip Fischer would be very much attracted to that. Another business that could be something like this would have been Alphabet. If memory serves me, I could be wrong on this, but if memory serves me, Motorola did get parts of it acquired by Google. So I'm not 100% sure about that, but the idea being that, you know, if you're looking at Alphabet, it's just a machine. You know, it just keeps on going, and it's that executive team where everyone pulls each other up. You know, remember that quote from I think it could be Buffett. It says that if you build a team of people below you, end up with a team of dwarfs, and if you build people that are higher than you end up with a team of giants. So it's that idea that everyone at Alphabet, the executives, are all aligned in their mindset to that longevity. There's that side project that they have, that they want to invest very strongly to make sure that their employees can last forever. You know, they have these side projects and the mindset there. So these type of businesses are very high quality, and I believe they could be something that Philip Fischer would have looked at. Moving on. I've done a video already on Peter Lynch, but Peter Lynch is someone else that's referenced here. So what works very well about Peter Lynch's strategy is that he was diversified in very many different types of ideas. So he had cyclical plays, he had high growth businesses, he had very, very slow growth but very, very cheap business. So he had a lot of different types of strategies. So this, when something is in favor, he could kind of come out of that, and when something was out of favor, he could go and double that on that. So he was invested, for example, in autos. So it's a very, very malleable investment strategy, which is good. Also, what people tend to forget a lot about Peter Lynch is that when he's saying, oh, you know, you as the investor need to understand that business, that is set in the 1980s. And that is not necessarily something that can be happening right now in 2020. So it's very difficult for you to understand the ins and outs of every single type of company that you might own. You know, for example, there are some high-tech businesses, let's say, in the payment sector, and you can kind of have an idea, okay, yeah, you might work in the payment sector, you can kind of, okay, this business is going to just take off, for example, Visa, for example. But if you just, all your investments are in Visa and MasterCard, you kind of like, okay, if that goes out of favor because the economy crashes, you kind of like, what else are you going to do? So what Seth Klarman talks about, which is not in this book, but Seth Klarman talks about that ultimately there's only so much that you're going to know about a business. Even if you're the CEO of that company, let's say you're the CEO of Walmart, and it's quite a simple business, you're not going to know every single thing. Even Warren Buffett says that you can't know everything about a business. You have to delegate certain aspects. So the same about Peter Lynch. Peter Lynch talks about you as the investor having to know, be very familiar with the key product or key service that company sells. Now, that has some merit, but he talks about going to malls and trying to see what works in one mall is very likely to work in a different mall. So I don't believe that can really happen nowadays. First of all, because malls up and down the countries are starting to close down. There's not a lot of physical footprint going through the malls. So that's the first thing. And the second thing is that the world's getting very, very much global. So rather than think about something working in a mall, let's say a watch, this watch is very cool, people might buy this watch because they're buying it in Oklahoma, they might go and buy it somewhere else. Rather than think like that, think about a business or a platform that can work on a global stage. For example, I have no position in Facebook, but that works in the United States, that works in Canada, that works in Latin America, that works in Europe. Like, you can have the argument about whether Facebook is undervalued or overvalued. That's a separate argument, but the idea of having the global scale is very appealing. And I can imagine that Peter Lynch, if he was investing in the present day as a manager, he would still be doing this kind of idea of what works in one country is likely at times to work in another country. So this ability of being able to scale up creates a lot of positive operating leverage that falls right down in terms of free cash flow and net income, and you can use that excess free cash flow for something else. So the idea of being able to understand the business, I think that has a lot of appeal, but I think it's important to have a little bit of nuance there. Moving on, Warren Buffett. So obviously Warren Buffett is someone that everybody knows something about, but what I want to add about Warren Buffett is that let's discuss the idea that he keeps morphing his strategy with the passing of decades. This causes a lot of contention, and it's something that I talk about quite a lot. So Warren Buffett presently is not really a buy and hold investor. And people say, Warren Buffett is always a buy and hold investor. Yes and no. So I give often two examples. So with the airline industry, back in April, when that kind of went a bit sour, he was out. He didn't feel that there was that much potential, and he was willing to sell into the weakness at the point of pessimism rather than kind of see how things may unfold. He may be right, he may be wrong, but I'm just saying that his idea is starting to morph slightly. This was something that he owned approximately 9.9% of the top 4 airlines in the United States, so it was very much a play on airline industry. And now he's like, I'm out. So again, we look at something like Apple, that he's making that purchase, and then when he feels, okay, I've got quite a large position in Apple, it makes up 25, or now probably a bit less than that, but approximately 25% of Berkshire Hathaway's holding. He's thinking, okay, this is a lot of concentration where I'm happy, I've got quite a lot of gains, and the market may or may not have still some contraction ahead, so I'm happy to kind of scale back on that position slightly. And if you listen to some of the interviews with Warren, he says that when he's thinking of selling, he's thinking of selling. He's not thinking of the position has run up too much. I believe that he makes these stories up for simplicity. I believe that in the case of Apple, he would still be quite happy to hold a large percentage of that stock in his portfolio. But anyway, so the best thing, check it out for yourself. Come over with my marketplace, Seeking Alpha, Deep Value Returns. I'll see you then.